Sally Beauty is the largest U.S. retailer and distributor of beauty supplies to the professional and retail market. Owned by Alberto Culver, the company had failed to meet its parents' expectations. Culver manufactures beauty products, and there were often channel dilemmas. Simply put, Sally's had become a non-core business unit. Up for sale, the original Sally's spin-off plan was unsuccessful. A stock transaction was announced with a corporate buyer. Unfortunately, the buyer's stock price plummeted and the deal was aborted. As a result of CD&R's existing relationship with Alberto Culver Management and the company's founding family, the firm was given the exclusive right to conduct due diligence on the business. Alberto Culver had clearly defined a minimum acceptable deal value of $3 billion, which was equal to the value of a failed spin-off of the Sally business that Alberto Culver had initially pursued. The value dynamics of this particular deal, however, were different than most deals in which CD&R participated. Three major differences stood out. First, whereas CD&R largely and historically created value by driving operational efficiencies, boosting margins, the proposed value of this particular deal required CD&R to achieve a top-line organic annual growth rate of 10% or more, a 40% boost. And all the CD&R partners know that achieving incremental revenue growth is much harder to predict than margin enhancement. Second, as part of the deal, CD&R would be purchasing equity in a highly leveraged, publicly traded vehicle. Transforming the strategy and operations of a public company was a proposition that many partners, especially those who had public company management experience, found daunting. Third, the firm would be investing as a minority holder without the usual control and the last say on all matters resting exclusively in their hands. Any of the risks inherent in this deal may have caused CD&R to call off its pursuit, but the economics of this particular business prompted the firm to press forward. Pedagogical objectives. We will use this case to explore the following topics: advantage sourcing, approaching investment opportunities with a unique perspective on value creation; risk assessment, identifying risk inherent in an investment and creating appropriate mitigation strategies. Third, enter retail without experience. Sally's was a first for CD&R in the retail sector, so understanding the key attributes of a retail investment, including stable demand and creating a sustainable competitive advantage, were all new to the firm. Fourth, growth capital versus control capital. Understanding the implications of varying levels of ownership in an investment. Fifth, public existence and exits. Avoiding the short-term myopics in public market analyst analytics and building/maintaining influence in a company beyond a mere ownership stake. Finally, sixth, learning from mistakes. Learning from investment and operational mistakes in order to refine the future investment process. Case questions. The following questions are often assigned to students to help prepare for class discussion. Industry attractiveness and risk. What trends and problems do you see in Sally Beauty under Alberto Culver's ownership and in the industry in which it competes? Can you identify the controllable and non-controllable risks in this investment and outline applicable mitigation strategies? Investment thesis and due diligence. Outline and be prepared to defend your investment thesis for the Sally Beauty business, including whether you would be willing to make the investment at Alberto Culver's stated minimum deal value. Which items of your investment thesis do you need to be most confident about, and how would you further investigate them? What is the concentration risk here? What is your mitigation strategy if L'Oreal misbehaves? Growth and margin aspirations. How realistic are the top-line growth projections required to justify Alberto Culver's minimum deal value? What type of margin improvements do you think CD&R could drive in the Sally Beauty business? Growth capital versus control capital. How should acquiring a non-majority share of the Sally Beauty business affect CD&R's willingness to invest? Change agents. If you elected to proceed with this investment, what type of leader or outside agents would you bring into the Sally Beauty business to help drive positive change? Exit. What are the key considerations for CD&R as they think through ultimately exiting an investment in Sally Beauty? Due diligence, primarily concentration. What is the biggest risk? Is it controllable or non-controllable? And what would be your best alternative if it did materialize? Assignment example. A popular assignment when this case is taught at Tuck, INSEAD, or UC Berkeley Haas follows. Classes are divided in half, one group to vote for buying Sally's, the other to vote against it. Students play the role of the CD&R deal team and argue their perspective in front of the CD&R Investment Committee. Case B. There's a surprise awaiting you, a one-page case that may be presented in class. A decision on what to do is introduced, and again the class may be divided to defend one of the two courses of action.